Okay, it's not quite time for class yet, but I do want to mention something. If you have not heard yet what DeepSeek is, you need to reevaluate your information gathering scheme because this is a big freaking thing. Mr. Long, what's DeepSeek?
It's a new AI platform.
It's a new AI platform. And it came from?
China.
China. Okay, now, on the one hand, it looks pretty good. I haven't played with it myself. And it's, for people who have to pay for it, it's about a quarter the cost of any of the American AIs. And so you're like, well, I get lots of cheap stuff from China and really enjoy it. What is the possible downside? Anybody have any ideas why DeepSeek might be a bad idea for Americans?
So if you're working for a business and you upload like intellectual property to that, you immediately get it.
Oh yeah. Are the Chinese really big on protecting intellectual? No. No. So, and the other thing is this. So the stocks of all those companies went down. Here's my prediction. That was an overreaction. And you will see them bounce back today, if it hasn't already happened. Also, it's open source. So the competitors will be able to look at what they've done and say, oh damn, that's pretty clever, and then incorporate it into their own code, and that's already happening. And so it looked like it might be the end of the world for some people, but it's really not. I do like to see additional competitors come in because it forces other people to pull their socks up, right? Now we know that they're going to have to, OpenAI and Perplexity, they're all going to have to become better. Does that make sense? Now, would I personally download this app and use it? No. For the same reason I wouldn't download and use TikTok. Well, there are two reasons I don't download and use TikTok, because it'll freaking rot your brain. But the other is because the Communist Party is looking around the corner every time you're flipping through those things. Now, how many of you would like to know the secret to high self-esteem? I've got it. You've already got it. Man, they'll wear shorts in this weather. Okay, so here is the secret to high self-esteem. Compare yourself to losers. Now, that's a little crass, but here we go. Let's think about it this way. What if I were to compare myself to someone that we can usually all agree is a winner? I will never be as rich, as talented, or as pretty as Taylor Swift. It's just not going to happen, right? And so I could go through my whole life feeling bad because I was not as rich, talented, or pretty as Taylor Swift and be a miserable human being. Don't be like that. Instead, in fact, there's an entire book written on this topic called Choosing the Right Pond. And it's, like about being a big duck in a little puddle, that sort of thing. That's by a guy named Robert Frank. And we actually have this in the library. I looked this morning. Oh, for shame, he's late. So, this book is all about that. Now, so what group should you be comparing yourself to? Well, let's think about my high school class. If I compare myself to the people I graduated high school with, I'm probably one of the most successful people from my high school class. Now, I don't tell you that it was a small group of people, right? But I can feel good for comparing myself to them. Another thing, so people don't realize this, but as far as research goes, there are these different levels of universities. And so you've got the University of Chicago, which is really high up there. And then you'll have, University of Missouri. And then here's Missouri State University. And then there are people on down below there. At Missouri State University, I'm a fairly good researcher. And I can feel good about that. If I were at Mizzou, I would be tail end Charlie. And I would constantly be the biggest loser in the department. Does that make sense? And so find a group of people that you're happy being around and that you can compare yourself favorably. And that will lead to higher self-esteem. Any questions? Okay. So let's get going here. We left off last time talking about asset management or turnover measures. And we said that there were two ways to reduce inventory. You could either increase sales or reduce the stuff going in. what do we say is never the answer? Increase sales. And we said that on your receivables turnover, you can improve your turnover by either increasing sales or reducing accounts receivable. What's never the answer? Increasing sales. And then down at the bottom, we have total asset turnover, sales of total assets. We could improve this by either making the sales higher or reducing total assets. What's never the answer? Increase sales. Now, longer term, of course we want to increase our sales, but you can never immediately or in the short term fix your problems by increasing your sales. Any questions? How do we get our accounts receivable down?
Stop offering credit.
Oh, what's going to happen to our sales? There you go. Right? I told you how to get your money.
Call your wife.
Call,
The wife. Not yours.
call the customer or send your wife, right? Does that make sense? If you don't have a wife, just pick up the phone and call, right? Okay, now probably if you're in a corporate job, sending your wife isn't a good idea unless your wife also works for the same company, right? That's like having your mom go with you to a job interview. By the way, don't take your mom to a job interview. I'm freaking shocked to hear that people are doing that. Just don't. Okay, let's talk about profitability measures. Our profit margin we can think of as how many cents in profit are we making for every dollar of sales. And this is accounting profit. Remember, accounting profit is not the same as cash, but this is how we measure profit margin. Now, net income, I could, in theory, increase my net income by increasing the price of my products, right? Does that make sense? So I can increase my profit margin by increasing the price of my products. What's that going to do to sales, though? Yeah, sales are going to go down. And so I could perhaps juice this profit margin by increasing my price, but I will have lower profits overall, perhaps. We need to find the optimum pricing there. So you got to be careful about these things. So we want profit margin to go up. Raising the price isn't the answer. What is the answer? If we can't raise price, we must lower costs. And there are two kinds of costs in this world. There are costs that our customers care about, and there are costs that our customers don't care about. And this second variety we call non-value added costs. Non-value added costs. And so we want to reduce these non-value added costs. We don't want to mess with our secret sauce over here. I'll give you an example. This was during the financial crisis. I was in Walmart. Always an unfortunate event to be in Walmart, but this day was even worse. I'm walking along and I said to my wife, I smell cheap chocolate. Now, for those of you who don't know the difference between expensive chocolate and cheap chocolate, expensive chocolate they use cocoa butter, and cheap chocolate they use vegetable oil. And I sniffed it out because I'm like a hound. I sniffed it out and I figured out it was a display of Hershey bars. Now, Hershey was supposed to be good chocolate, but they cheaped out and they started using vegetable oil. I hope they've reversed this. Now, do you think they lowered the price of the Hershey bar? No. If you're going to try to sell me cheap chocolate, if that's all I can get, guess what? I'll buy actual cheap chocolate, right? And so that's a good way for them to hurt their sales. Let's talk about a way that you could lower some costs that your customers don't care about and might even be thrilled for you to do. Do you guys know what spark plugs are? Spark plugs are those little things that you screw into your engine that they make an electrical spark to ignite the gasoline in an internal combustion engine. It's gasoline. Now, when you buy those, anybody here change their own plugs? All right, when you buy those, how do they come packaged?
Pack of like 4 or 8.
Yeah, and so you open the box, and how are the individual plugs packaged?
In plastic.
or they're each own their own little containers, right? Now, that may be fine for the person working in their garage, but imagine you are building cars. You're a Ford or you're Nissan, and you're screwing in thousands of spark plugs per day. Do you want to be standing there opening those packages? Oh, they're a pain in the butt as it is, right? But to do that, to produce cars, is totally insane. So how could I cut this non-value added cost? Well, first of all, I could use recyclable packaging. And not just recyclable, reusable. So basically, I put the spark plugs in trays. And they're grouped by, it's 4, 6, or 8, right, for the engine. And they're grouped that way. And after Nissan or Ford gets through using those spark plugs, they send me that tray back. My packaging cost is 0, right? I've gotten rid of some costs that didn't bring any value to the customer. In fact, it was giving the customer pain. And so that's the kind of stuff we're trying to get rid of. Do customers care how many miles stuff travels inside your factory? No. Line up your factory to be as straight through as possible so you don't have... We actually tracked something one time in the factory in Duncan, Oklahoma. Just one part. I think it traveled more than 12 miles in the factory because it was zipping all over the place. If we just had things arranged more carefully, then we could cut that down by maybe 2/3. And what does that mean for the amount of fork truck drivers we have to have? That's one of those non-value added costs. So that's how I improve my profit margin, is to get rid of non-value added costs. Now, profit margin, I've already told you, is an accounting idea. And if we want to get down to something that isn't as cluttered as profit margin with accounting stuff, we could look at EBITDA margin or EBITDA margin. Now, we all know what EBIT is. Can someone tell me?
Depreciation, amortization.
Oh, you jumped to the next question. I said, what's EBIT? Earnings before interest and taxes, right? And the DA is?
Depreciation, amortization.
Depreciation and amortization. Now, for those of you who don't know, amortization is something very similar to depreciation, but it's what we do for forests. When we have an asset that's forest. If we cut 20% of that forest, we amortize 20% of the cost of that forest during the year that we cut it. And the same thing with oil wells and with mines. Now, oil wells and mines are a little different. Do we actually know how much stuff is there? No, it has to be estimated by scientists and other geeks. But with a forest, it's real easy, right? We can look and say, well, there's 4,000 trees there. We cut down 1,000 of them. Therefore, we must amortize 25%. But here's what you need to know about both of those things. They represent non-cash expenses, right? So if we want to get rid of non-cash stuff, we can say earnings before interest, taxes, depreciation, and amortization. And by the way, in finance, we don't think of interest as a cost of operations, right? We think of it as a financing cost, which it is. Where do accountants put that? Ms. Wayne-Dana, are you an accountant?
Yes, sir.
Yes. Where does interest show up? Is it in the operating cash flows, or is it down in the financing? And in accounting, it's actually, they put it in the operations. And the reason they do that is because of the tax impact. So what we're going to do is we're going to back that out. So we're trying to get to an operating profit margin. That's what EBITDA margin is. It's an operating profit margin. Now, the only thing that I don't like not being in there is taxes, because taxes are a real cash flow and taxes are a result of your operations. But we're getting closer. It's definitely closer to say that EBITDA margin is an operating profit margin than to say profit margin itself is. Okay, so we take our EBITDA and divide by sales. Why would I do that? Well, what if I were comparing between two companies? And one company has a relatively large amount of debt and relatively new machines. Well, those people would have relatively high interest and they would have relatively high depreciation. If I'm trying to figure out about operating efficiency, then I want to get rid of those differences and be able to use EBITDA margin to compare the efficiency of their operations. So this is really just focusing in on operations. Any questions about EBITDA margin? Yes?
Is it usual to always have both depreciation and amortization, or we can have one of them?
Most companies do not have amortization. Not all companies have depreciation, but most do. And I'm pleased to see you have the correct calculator. Okay. Yes?
So if a company does have depreciation or amortization, are they still going to use EBIT sometimes? Or
Oh yeah, so
always
things
use EBITDA if they have?
so these ratios all have their purpose, right? And so you may see people using both EBIT and EBITDA, and they're telling you a couple of different things. So now, if you want to compare operations, though, EBITDA is the way to go. Other questions? Okay, now let's talk about return on assets and return on equity. So return on assets tells me how well am I using my assets to produce a profit. How well am I using my assets to produce a profit? Do we like owning assets?
No,
No, why not?
because assets can cost, it's like gardening, so it takes a process too.
Okay, so assets, and I think we could think of it as being like inventory, which of course is an asset. Would I like to carry a lot of inventory? No, I prefer to run a zero inventory. Would I like to manage a lot of factories? No, I prefer to have zero. In fact, if you take a look at Apple, does Apple make any of their own stuff? No, they're running on an asset-light model. That stuff's made by Foxconn and Pegatron and some other people. So what I want to do, if I can, is to run on as few assets as possible. By the way, how would I go about increasing in the short term my return on assets? Would I try to increase net income by increasing sales, or would I try to reduce my assets? Yeah, sell assets. Now what kind of assets are you going to sell? Ones you're not using. Right? Ones you're not using. If you've got, in every company I've ever been at, we've always had old machines over in the corner covered with a tarp. And they sit on the books year after year after year. What should we do with them? Sell them. Does that make sense? So we want to run on as few assets as can support our business. And then we have return on equity. This is a measure of how well we are using our shareholders' equity investment to produce a profit. What's the goal of financial management? Maximize shareholder wealth. Who holds the equity in the firm? Shareholders. So this return on equity might be more closely aligned with our goal than perhaps return on assets. And I can tell you that when we are looking from a shareholder's perspective, we're certainly more interested in ROE than ROA. If I told you that a firm only had ROA of 1%, would you be interested in buying the shares of that firm?
Yeah,
Yes, why?
because most banks are between 1 and 2%.
Dang, you are good. I've got to give you one of the challenge points here, because that answer was just way too good. Have you received one of my challenge points yet? There you go. Okay. Now, what did he say? He said banks. Yeah, because banks are running on 90% debt, their equity multiplier is really close to 10. And when you multiply, we're going to see that ROA, or ROE is just ROA times the equity multiplier. You're going to have an ROE of around 10%. For a business with the risk profile of a bank, that's pretty good. And so people, of course, are interested in owning the shares of banks. Does that make sense? Okay, what if I had a firm that was all equity? What would be the relationship between ROA and ROE?
There you go.
Yeah, they'd be exactly the same. They would be exactly the same. Okay, so who cares about these measures? Well, this is one of the things that we would look at in my monthly meeting between me and Jack, and also the external analysts and competitors. For example, if I want to compare my operating efficiency with a competitor, I would want to figure their EBITDA margin. Questions? Okay, now we're on to the market value measures. And the first one we talk about is earnings per share. Whenever you hear accounting people talk about earnings, they are talking about net income. It's accounting earnings. And we're going to take the net income and divide by the shares outstanding. If I tell you that a firm has $1 earnings per share, is that good or bad? You can't tell. You can't tell. And here's why. Well, there's one thing I can tell for sure. The company is profitable, right? Because if they are losing money, that earnings per share would be negative. Does that make sense? But if I don't know the number of shares outstanding, I don't know how much profit we're talking about. Also, earnings per share is really only useful in comparisons for the same firm over time. Is the earnings per share greater than it was the same quarter last year? If so, that's good. Is the earnings per share greater than the analyst expectation? If so, good. I could have two companies that are identical, and one could have 10,000 shares outstanding and one could have 100,000 shares outstanding. The one with 10,000 shares outstanding is going to have an EPS that is 10 times higher. Does that make that firm better? No, it's the pizza problem, right? If I cut that pizza into 8 pieces or 16 pieces, it's going to affect this thing, and not in a way that really matters for the value to the shareholder. Questions about earnings per share? So the two things we can compare to, what are they? So the previous earnings per share, and what's the other? Yeah, the analyst expectations. Those are the things we care about comparing to. Now we've got the price to earnings ratio, or PE ratio. And that is the price per share divided by earnings per share. By the way, let's talk about where we get some of these numbers. Where would I find net income? Yeah, the income statement. Where would I find the number of shares outstanding? So the financial statements, undoubtedly on them somewhere will have that. So let's say annual report would be one place. Also, Google Finance, Yahoo Finance will tend to have that sort of information too. If at a last resort you can Google the name of the company and number of shares outstanding and see what happens, right? Okay, that's where I find the shares outstanding. Where do I find the price per share? Second?
Trading view?
Yeah, it's the trading data. It's the price that's currently out there, right? And you can also find that Yahoo Finance, Google Finance, the Wall Street Journal, all sorts of places you can find the price per share because it's just the market price of a share today. Okay, now let's talk about price per earnings. It's going to vary by industry. It's going to vary by industry. And the reason it varies by industry, I'll prove to you later that PE is mainly about expected growth. So let's say a firm has two different firms. One of them currently has earnings of $1, and the other one currently has earnings of $1. If the first one has a price of $7, then that PE ratio is going to be 7. If the second one has a price of $14, then that PE ratio is going to be 14. Now we could think of this in terms of that the people at the PE7 firm are willing to pay $7 for every dollar of current earnings, present earnings. Why would people be willing to pay more for the same dollar at another firm?
I mean, it's expected to rapidly grow.
Yeah, it's expected to grow faster, right? So the one with a PE ratio of 7 is going to be a fairly low growth firm. When I was a boy tracking my dad's stocks for him, because that was a deal in order for me to be able to get the Commodore 84 computer. Anyway, so I was tracking his stocks for him. PE ratio for his utilities was around 7. Why? They pretty much just grow at the rate of inflation. There's not some big outstanding growth. But what about companies like Microsoft or Google? We expect them to grow faster, and so their PE ratios are higher. Now, my Chinese EMBA students are always interested in PE, and they would ask me, should I buy low PE stocks? And I say, yes. And they say, should I buy high PE stocks? And I say, yes. Now they're getting really confused. And they say, should I buy medium PE stocks? And I say, yes. Buy them all. This is what I'm going to teach you in chapter 11. Buy them all. For 2 reasons. Number 1, a diversified portfolio, right? You're diversifying your risk. Number 2, these things are on average correctly priced in the market. On average correctly priced. Now, are they all correctly priced? No, but on average they are. So why not just buy all of them? So don't say, well, I would never buy that stock because the PE is only 2, or I would never buy that stock because the PE is 50. On average, these stocks are correctly priced, so buy them all. Questions? Okay, let's talk about market to book ratio. On the top of this ratio, we have the market value per share. Any idea where we would find the market value per share? I'll give you a hint. We've already discussed it today. Yeah, it's just the share price, right? It's just the share price. So you could right above that also price per share. The next one's a little trickier, and that is the book value per share. The book value per share. So here's what I'm going to do to find book value per share. I want to go to the balance sheet, and I want to look under that owner's equity. And the owner's equity, I want to take anything associated with common shareholders. So if there's no preferred stock at all that is going to be owned by the common shareholders. If there is preferred stock, I want to back that out. And that's going to be the book value of the equity. How would I then find the book value per share, Ms. Gann? How am I going to find the book value per share? I've got the book value. Yeah, I'm going to divide by the shares outstanding. Does that make sense? That's going to give me the book value per share. And this thing is going to give us a market to book ratio. Now, market to book ratios, we hope to be greater than 1. We hope that the value of the firm is greater than just its book value. And in fact, Warren Buffett, and I don't like Warren Buffett all that much, but even a broken clock is right twice a day. Warren Buffett says, don't buy shares with market to book value less than 1. It's like telling managers you're going to give them $1 and expect something less in return. If any of you are into that sort of deal, bring your dollars to my office, and I will make your dreams come true by returning something less than to you. Does that make sense? So you don't want to do that. Now, here's the fun thing. Warren Buffett can invest in market to book less than 1 firms and come out on top. Why? Any ideas?
Buy them for cheap, strip the parts and sell them off.
Okay, he could do that. That's one route. But here's what Warren typically does. He'll buy the firm and then fire the loser managers. By the way, do you think Warren Buffett actually knows some people who know how to run companies? Yeah. Do you think Warren has someone in mind if he buys a loser company for who he wants to stick in there to fix the problem? Yeah. So Warren can go out there and buy a company, change out the management, and get that market to book back above 1 and make a lot of money in the process. Now, why can't you do that? Yeah, you don't have $1 billion, right? Does that make sense? You see these books that say investing the Warren Buffett way. When you turn to page 1, the first thing it should say is get your hands on $1 billion. Because you're going to need that if you're going to try to invest like Warren Buffett. And so I'm going to tell you, don't try to emulate Warren Buffett. I'll tell you, in fact, I usually beat Warren Buffett with my investments. And it's not because I'm that smart. I'm not. Apparently I'm smarter than Warren. But I just buy the S&P 500, right? Go back and look and see how many years the S&P 500 has beat Berkshire Hathaway's returns. Plus, I don't have to pay for Warren, which is nice. Okay. Any questions about market-to-book ratio? By the way, do you think some firms, if you think different industries might have different market-to-book ratios? Absolutely. And it comes back to some of the stuff that we talked about before. So what you want to do is compare within an industry. If you've got 3 firms in the same industry and they've got market-to-book of 2, 2, and 1.25, what do we know about that last one? There's something wrong going on there, right? Does that make sense? Okay, now let's talk about market capitalization. Once again, price per share shows up. That's just the price that the stocks are currently selling for, multiplied by the number of shares outstanding. Another name for market capitalization is the market value of the equity. Another name for market capitalization is the market value of the equity. And by the way, all the stuff we're talking here is common stock. Common stock. Now, why did I just tell you about market capitalization? Well, you'll hear people talk about market cap all the time, so now you know what that is. And the second thing is, it's going to go into calculation of enterprise value, or EV. Now, you could just look at the market cap, but that's going to be different between 2 otherwise identical firms with different capital structures. And so when we get to the EV multiple versus our PE ratio, the EV multiple is more like an operational thing. So how do we figure this enterprise value? Well, we're going to take that market capitalization, which is the market value of the equity. We're going to add the market value of the interest-bearing debt. Let's talk about interest-bearing debt. Accounts payable, is that interest-bearing debt?
Yes.
No, not if I pay it within the terms, right?
So.
It's not interest-bearing. Accounts payable, this is money that I owe people.
Yeah.
For goods that I've received that have not yet paid for.
Yeah.
What's the interest rate on that for the first 30 days? 0, right? It's like your credit card. As long as you pay it off every month, do you ever pay any interest? No. So it's not an interest-bearing debt. Now let's talk about notes payable. Notes payable is money you borrowed from a bank, so that would be interest-bearing debt. And then anything in the long-term debt would be interest-bearing debt. So we're going to add those together. And then we're going to subtract out the value of cash. So those first 2 things together is basically the market value of the firm. The first 2 things together are basically the market value of the firm, including both debt and equity. But then we want to subtract out the impact of cash. And the reason we don't want cash in there is because it's not part of the value of the underlying enterprise. Let's talk about 2 different companies. And the numbers have probably changed here. I haven't kept up with it. But at one point, Exxon and Apple had the same enterprise value, or roughly the same. And you say, how can that be? Apple is worth way, way, way more. The answer is this. Apple's market capitalization was huge, but they had very little debt. And they had a boatload of cash on their books. And so if I take huge market capitalizations plus very little debt and then subtract out a bunch of cash, it turns out that I came out pretty close to Exxon, who had a middling market capitalization but had a lot of interest-bearing debt. And they weren't carrying undue amounts of cash. And so they would end up with basically similar enterprise values. Does that make sense? Okay. By the way, do shareholders want companies to hold a bunch of cash? No. Man, I can do that for myself, right? If you're holding, and by the way, whose cash is it? Yeah, it's the shareholders' cash. And so if you don't have a positive NPV, a good project to invest the cash in, what should you do? Send it back to shareholders, either through dividends or repurchases, right? Because those people might be able to go out and buy something else that would bring them better returns than whatever crummy project you were going to invest in. Or even worse, just letting it sit in the bank. I can do that with my own money. So then we can move on and use this enterprise value and EBITDA to come up with something called the EV multiple. And you can think of the EV multiple being an operating PE ratio. The EV multiple is simply an operating PE ratio. So price to earnings is clouded by the cash on hand. It's clouded by the capital structure of the firm, all sorts of other things that are going on there, and of course depreciation. When you get down to calculating the EV multiple, all that stuff goes away and you are left just looking at basically a PE ratio for the operation, for the enterprise. The same things make EV multiple high that make PE high, and those would be high growth or lower risk. Higher growth or lower risk will make this EV multiple higher. And it's the same things that make price to earning higher. Higher growth or lower risk. And I will mathematically prove that to you later on. Questions? I know you guys are just dying for a mathematical proof. Okay. I can tell you're stoked. So let's talk about some final thoughts here on ratio comparisons. First of all, only compare ratios between companies in the same industries. For instance, when we look at the total debt ratio, if I compare an electric utility to a bank, it's going to look like the bank has crazy amounts of debt. The bank has the correct amount of debt for a bank. The utility has the correct amount of debt for a utility. Now, typically, what makes you able to take on more and more debt, the safer your cash flows are, the more debt you can take on. The riskier your cash flows are, the less debt you will take on. Because debt is a fixed payment. If I don't know where my next paycheck's coming from, is it smart for me to have a car payment? No. Right? Does that make sense? Okay. And optimum levels will actually vary inside the same industries for companies with different strategies. So I'll give you an example. And my example is going to be in the hardware store area. And so you are all familiar, hopefully, with Home Depot. You know Home Depot? And are you familiar with Ace Hardware? Ace Hardware is a smaller player, and they have different strategies. When you go into Home Depot, you expect to find lots of items that turn really quickly. So they're more like a grocery store. Do you think they carry everything you might need? No. So the first thing is Home Depot, their strategy is to focus on things that turn a lot. So they want those high inventory turns. But that means that they're going to be missing out on a lot of the things that don't turn as much. And so if you go there, you may not find what you want. For example, I was looking for a new brake hone. You guys probably don't even know what that is, but I wanted a very small brake hone. The smallest brake hone they had was 4 inches in diameter. I'm wanting something that's like half, something very small. They don't have it. On the other hand, Ace Hardware, I have never walked into an Ace Hardware and not found what I wanted. Now, they have tiny facings of each thing, and they may only have 3 or 4 of them. And because they tend to be more specialty items, what do you think the inventory turns look like? That's a lot lower, right? Now, so there's one big deal that we can see between those two. We know the inventory turns are going to be higher at Home Depot. They're going to be lower at Ace Hardware. Now you say, well, wait a minute, this means Ace is obviously inferior. Wrong. What do you think Ace can charge for these things? Yeah, they can charge more. By the way, you go there, you're desperate, your toilet is malfunctioning, you're going to be willing to pay to get the right part. So the other thing that differentiates their strategies is that Home Depot will basically just hire, and don't feel bad if you're a Home Depot person, they will hire anyone who can pass a drug test and fill out the application. I mean, that's your basic qualification for Home Depot. Ace, on the other hand, says that they are the helpful hardware place. It's a little annoying. Every time I walk in there, they're like, what do you need? I'm like, oh, I need some metric bolts. Oh, what size? And I'm like, hey, just let me go look at the bolts. If I need your help, I'll ask, right? But I will tell you a time when I was very happy about Ace. I went to Home Depot for a toilet flapper. You guys know what a toilet flapper is? It's that thing that lifts up in your toilet to let it flush, which is a blessed thing, right? So I go in there, and my wife says, the toilet's making a noise, you need to listen to it. And so I listen to it, and it goes, brrrr, brrrr. And I'm like, ah. And so I lift up the lid, and I see that the flapper is kind of hardened, and it needs to be soft in order to make the seal, right? So that's why it's leaking. And so I go to Home Depot, and I'm standing there looking at the assortment, and there are all these toilet flappers, and there are none of them for my special weird Japanese toilet, the Toto. I didn't buy the toilet, it came in the house, right? And so I'm looking at this, and I'm like, And this guy, this Home Depot guy, kind of staggers up. He's a teenager, he smells like weed. And he says, can I help you? And I said, yeah. I said, this flapper says it's universal, but it doesn't look like the one in my toilet. Do you think it'll fit my Toto? He's like, of course, man, it's universal. I was skeptical. And so I left Shaggy there, and I went down to Ace. And I walk in the door, and of course they jump me right in the door. They're like, what are you looking for? I said, toilet flapper. And they said, well, what's your toilet doing? And I said, brrr, brrr. The guy says, wait a minute, is it a Toto? I said, yes. He says, does your wife use those chlorine tablets in the tank? Because he knew it wasn't me, right? I said, yeah. How did you know? He said, Toto flappers are not chemical resistant. And so you can't use that stuff in your tank. He says, let me guess, your flapper is baby blue. I said, yeah. I said, isn't that the color they're supposed to be? He says, no, they're supposed to be royal blue. He says, let me show you. And we walk back through, and by the way, the aisles at Ace Hardware are tiny because they're crammed a bunch of crap into a tight space, right? And we go back there, and he pulls one off the shelf. He has to blow a little dust off of it. Why? Low turns, right? And he says, this is what your flapper's supposed to look like. And lo and behold, it was royal blue. I'm like, dude, how do you know all this? He said, I used to be a plumber. Now, what do you think the labor costs look like at Ace Hardware versus Home Depot? Yeah, it's got to be higher. You got to pay a former plumber more than you have to pay Shaggy. Does that make sense? Oh, and by the way, if you can't afford to send your kids to school, send them to plumbing school. If you can't afford to send them to college, send them to plumbing school, or get them a State Farm insurance agency. Either way, they'll be rich. Questions? Okay, so even within the same industry, different strategies can cause you different ratios. And a lot of times you can't apply a bigger is better mentality to ratios. We were talking about how you could boost your profit margin and really damage your business. You could also boost your inventory turns and damage your business with the stockouts that we talked about. Also liquidity ratios. You know, the bank might be thrilled for you to have a cash ratio greater than 1, but what about your shareholders? Oh, they're going to be really mad because you're sitting on way too much cash. And so what do you want to do? You want to look at other firms in the same industry and see where the most of them are hanging out. And that's basically your target to shoot at. Does that make sense? Yes?
You have a company who's kind of starting a new industry, like let's take SpaceX for example, would they compare themselves to NASA because they live in the same industry, but one's
Okay.
private and one's government?
Okay, so let's talk about, and he's right, when you start something from scratch, you've really got no freaking idea. Other than I can tell you this with certainty, should they have started SpaceX with a bunch of debt? No. Why? Do they have a regular paycheck? No. And in fact, when they started that up, I'm like, that ain't gonna work, right? But did it? Yeah. Would I have ever loaned them money? Absolutely not. I might have bought some of their equity just to be speculative, and just because of my diversified portfolio idea. So when you're starting something like that, you don't know. Now, you mentioned NASA. Anytime the government gets involved in something, what do you think the costs are going to be? Higher. And what do you think the success rate is going to be? Lower. Yeah, think about this. The government's been working very closely with Boeing to get this space capsule up and running. You guys haven't been following the news, or you would realize that it's a total piece of crap, right? It's like the Chevy Vega of the space world. Whereas SpaceX, scrappy startup with a profit motive, they've managed to figure it out. So, when you get government involvement, because, by the way, do you think NASA employees get profit sharing? There's no profit, right? Who do you think's more motivated to make the rocket work? The NASA engineer or the SpaceX engineer? SpaceX. Yeah. Okay. So, and the other thing is this. The only thing I can really see, I can see NASA's budget. Does NASA actually have sales? It gets really messy. And NASA's involved in a bunch of stuff that SpaceX isn't. SpaceX isn't sending deep probes out. SpaceX isn't. There's a lot of non-commercial things that are going on at NASA. And so you're absolutely right. Starting something new, basically you're starting from scratch. But if it's risky, and if it's new, it's risky, right? Then you don't want to be financing it with debt. You want to finance it with equity. Questions? Okay, now let's move on to the DuPont ratio. DuPont Identity. Okay. A lot of times students think that this is just another way of calculating ROE. Oh crap, I gotta get this up here. Let's take a look at this. So we've got ROE is equal to net income over total equity. Now, if I multiply by, total assets over total, sorry. I'm just gonna start over here. I'm gonna show you how to get from ROA to ROE. What is ROA? Net income over total assets. That's ROA. Now, if I wanted to end up with net income over total equity, I would multiply this thing times the equity multiplier. And so what does that do? What happens to the TAs? Cancel out. So this is really just ROA times the equity multiplier. So here's the problem. Earlier we said that ROE might be one of the closest related things to our goal of maximizing shareholder wealth. And so you might be inclined to tell your managers that their job is to maximize ROE. Here's the problem. If I just tell them to maximize ROE, what they're going to do is borrow money and buy back stock. If I tell them to maximize ROE, they're going to borrow money and buy back stock. And the reason they're going to do that is to increase this equity multiplier. By the way, remember, equity multiplier is 1 plus total debt over total equity. In order to blow that thing up, all I have to do is take on debt and buy back equity. Does that make sense? Now, what happens, though, to the riskiness of the firm as we take on more and more debt? Yeah, it increases. So I'll give you an example here. My parents have not owed money to anybody since 1976. What is the chance of them going bankrupt?
Very slim.
It's very slim, right? Basically, they've just got their monthly bills. As long as they pay their monthly bills, there's no way. Now, I owe $175,000 on our house. That's all we owe left on our house. But I have this great government job. I have tenure. What are the chances of me going bankrupt? Well, they're higher than that of my parents, but they are lower than that of my neighbor. My neighbor is a spine surgeon, and he gets paid by the spine, right? And he's got medical school debt out the ears. He drives a brand new BMW M5. And I'm pretty sure that he basically is he owes probably $300,000 on his house, at least. Now you add all that together. We've got the high fixed payments of his debt. By the way, do you think he paid cash for that M5? No. We've got the high fixed payments of his debt combined with the risky cash flows, because what if suddenly they stop throwing spines to him? And that's the way he put it. He's like, I may have to leave Mercy. I'm like, why? He says, they're not throwing me enough spines. Does that make sense? He's getting paid by the spine. So, who's more likely to go bankrupt? Me or him? Him. Does that make sense? And it's the same way with companies. If you've got higher debt, you've got these higher fixed cash payments you've got to make, and the jankier your cash flows are, the less likely you can afford to make those payments. Okay, so I don't want them to blow this out. I don't want them to do that. That increase in ROA would just represent an increase in the risk that I'm taking on. And so what we've got to do is figure out some way to keep these crafty managers honest. And the answer comes to us from something called the DuPont Identity. Now, before we go too far, I want to tell you a little bit about DuPont. DuPont, I'm not even sure they're still around by that name anymore, but DuPont was an American chemical company, one of the biggest companies in the U.S., and it was known for doing things well. I was actually in the toothbrush bristle plant of DuPont in Parkersburg, West Virginia, and it was just amazing how well they had their crap together. They were known for doing things well. Now, before they got into toothbrush bristles, they used to be in the dynamite business. You guys know about what dynamite is? It's an explosive used in mining and construction. My dad worked at a dynamite plant, and it turns out that the way dynamite plants are constructed is not like you might expect. It's not one big building. It's a series of buildings. and the one where my dad worked, they were all in a line, and they've got a space between them. Why do you think they might have that?
Which one blows up?
Yeah! If one blows up, hopefully it's just gonna kill that one guy, right? Kenny Frey, 1972, no kidding. Okay, now, 1966, the whole darn line went. And so those are the 2 times my dad's nearly been killed on the job. Okay, now this is what it looked like where I'm from. But at DuPont, their dynamite plant looked like this. Now here's the problem. They had, by the way, do you think safety might be important at a dynamite plant?
Yes.
Oh, yeah. Oh, very much so. Okay, so the problem was DuPont was having a lot of accidents, and they were happening primarily on the night shift. What do you think accidents might happen primarily on the night shift?
Sleep is
Yeah, so first of all, humans are not, I mean, you guys probably think you could stay up all night and be perfectly fine, but you can't, right? That's not how humans are meant to function. And so one is we're off on our circadian rhythms then. The second one is when you hire in new people, where do they go? Night shift or day shift?
Night shift.
Yeah, the night shift. Now, what does that mean? We've got our least capable people operating at the worst possible time of day. Now, how does one get from night shift on to day shift?
They're good.
Say again?
They're good.
Someone on the day shift.
Yeah, someone on the day shift has to move out, right? And it's either through retirement or death, right? That they move on. Now, it may be a while before you get there. And the problem is, and by the way, what kind of people, and it's usually seniority, not how good you are, it's usually seniority. And so in order to be around long enough to get onto the day shift, you have to have been smart enough not to have been killed on the night shift. Does that make sense? And so your day shift is typically smarter than your night shift. It's a natural selection. Okay. Oh, it's horrible, isn't it? Okay. Now, this is going on. Now, the big question is this. When do managers typically, when does a plant manager typically, when are they at the plant? On the day shift. Is that really when they needed the manager to be there? No. Now, you could not get by with this solution today, but you could back when DuPont did it. Here's what they did. They built a lovely home right in the middle of the compound. And they said, if you want to be the manager at this plant, you will move into this house with your family. So where is the manager now at night?
Like on there.
Right there. Now, and what does the manager have at stake here that he didn't used to have?
This house.
The house, and more importantly,
Family.
family, right? You want to make your wife mad, get killed. If you want to make her really mad, get the kids killed, right? And so there was a tremendous incentive for this person. By the way, what do you think happens with the first whiff of smoke? Now, do you think the manager's rolling out of bed and running out there in his jammies to put an end to this crap? Absolutely. What do you think happened to the accident rate at DuPont? Right? Now, once again, you couldn't get by with that today, but it does tell you how creative these people are with coming up with a solution. And they've done the same thing to this equity multiplier problem by breaking it down. They broke it down into something called the DuPont Identity. And by the way, if I have a formula on the screen, is it going to be important to you? Yeah. Okay, so ROE, we're going to break it down into profit margin, total asset turnover, and equity multiplier. Profit margin is net income over sales. The total asset turnover is sales over total assets. And the equity multiplier is total assets over total equity. What happens to total assets? Cancel out. What happens to sales? Cancels out. And that leaves us with net income over total equity. So I've proven to you that the DuPont Identity actually gives us return on equity. Now, why is this important? Because each of those things represent something. Profit margin represents operating efficiency. Remember, I told you that the way to improve your profit margin was to eliminate non-value added costs. What's another word for non-value added costs? Waste. We're eliminating waste. And by eliminating waste, you can improve your operating efficiency. And then we want to talk about total asset turnover. That's a measure of our asset use efficiency. How well am I using my assets to produce sales? And then, of course, the equity multiplier represents financial leverage. And here's what we're going to tell our managers to do. We're going to tell them to increase ROE by working on operating efficiency and asset use efficiency, and keep your grubby fingers off of the capital structure. The equity multiplier is to remain the same. We're assuming we're at our optimal capital structure. Now, what does this mean? You say, well, wait a minute. I could go out there and raise my prices and maybe get a higher profit margin. What's that going to do to sales? Sales are going to go down, and what's it going to do to your total asset turnover? It's going to decrease it, right? And so you're doing this. This one's going up, this one's going down. When you multiply them out, you really haven't helped yourself. In fact, you might have hurt yourself. Now, when we say, well, wait a minute, I know what we'll do. We'll lower the price, and that'll increase the sales, and it'll increase the total asset turnover. She says, no, why not? What's that going to do to profit margin? Right? Yeah. And so once again, this is a cheat-proof thing. If you focus on profit margin and you do it the wrong way, you're going to hurt your total asset turnover. If you focus on total asset turnover and you do it the wrong way, then you're going to hurt your profit margin. And so this is really and when you get to be a manager, you want to look for these cheat-proof measures, because what do you think people will do if given the opportunity to game the system? In fact, what was your professor's advice to you last week? Figure out how score is kept and play the game accordingly. Does that make sense? Okay, so you've got to figure out these cheat-proof measures, and that's what the DuPont analysis is all about. Questions? Okay, let's talk about problems with financial statement analysis. First of all, conglomerates. What are conglomerates? Anybody have any idea?
It's when you have like businesses, like you go to a group of businesses, but they're like not related.
Yeah, businesses, and they got different divisions, and they're not related. And these were big in the 70s and 80s. But here's what you need to know. If you've got a company that is playing in different industries, it makes it really difficult, if not impossible, to do ratio analysis. And here is why. Remember we said these ratios vary by industry? Ratios vary by industry. And so when I worked for Halliburton, we were truly a conglomerate. We had all sorts of oil field stuff, but we also had an insurance company. Now, I was unrelated. They finally sold it, thankfully. But it was unrelated, and it made our numbers where you really couldn't compare us. And by the way, our main competitor, Schlumberger, they were doing a lot of the same things that we were doing, but they were doing them in different concentrations. For instance, we were much bigger in oil well cementing and fracking. They were much bigger in logging wells and things like that. Additionally, they made gasoline pumps. And to this day, when I'm filling my tank, I always look to see if it's a Schlumberger pump that I'm using. If it is, I kind of growl because they're the enemy, right? But that's a conglomerate, right? And by the way, they also make gas and water meters. And so you couldn't really compare, even though those are known to be like the two big players, you couldn't really compare the numbers. And then you have seasonality. Let's talk about how inventory turns would fluctuate based on seasonality for a company that makes Christmas candy. It's January. What does the inventory at the Christmas candy place look like? It's really low, right? And so if you look at the end of the year, the inventory is low, but the sales are what? right? So inventory turns look great for the fourth quarter for the Christmas candy company. And then throughout the year, they are building up inventory. They're buying raw materials. By the way, sugar will keep a long time. Buying up inventory. They're also creating the candy that has a longer expiration date, like the hard candies. They're building that stuff up. So what's happening to their inventory through the year? It's going up. What do the sales look like at a company that makes Christmas candy in the first, second, and third quarters of the year? Yeah, they're low. And so that inventory turns is going to get worse and worse and worse. And so you can't just look at it and say, well, wait a minute, fourth quarter we had great inventory turns. Now we don't. We must suck. No, it's just a seasonality. If you want to compare, what you want to do is compare against last year's fourth quarter, right? If our inventory turns for last year's fourth quarter were 25 and for this year's fourth quarter they were 17, then maybe we've got a problem. Does that make sense? Okay. And then we have different accounting methods between countries. We have the generally accepted accounting principles here in the United States versus the International Financial Reporting Standards. And then there's some other country-specific accounting stuff that goes on, but those are the big two. Now, here's where this comes into play. And we talked about this a little bit earlier about research and development. In GAAP, under GAAP, you have to expense research and development when it happens. Under IFRS, that's how you pronounce that, IFRS. Under IFRS, you can start to capitalize your research and development expenditures after you reach what's called technical feasibility. What's technical feasibility? I have a real big problem with this term because as an engineer, I'll tell you the only way I know when this thing is technically feasible is when I actually get the thing built, right? I've got a project I'm working on at home right now, and I'm on like Rev 3, and it's still not right. Now, is my concept sound? Yes. Is it technically feasible? Until I can make that puppy run and run right? Absolutely not. But I digress. So you could have differences in your R&D expenses. And what is that going to mean for your profit margin? Profit margin is going to be higher at IFRS companies than at GAAP companies. Okay, now you also have differences in currencies between countries. For instance, in China, it takes about 7 yuan to come up with $1 US. And so if I saw that a Chinese firm had a net income of 1 million and a US firm had an income of 1 million, the US firm would actually be 7 times better off. So that's at the simplest, just talking about the conversion. Now, the more important thing is the fluctuation. Because these currencies fluctuate with regard to each other. And so it could, just simply a currency fluctuation could make a company look better or worse in these financial ratios. You need to take that into account. And then finally, we have the differences of accounting, the different ways that we account for inventory. Does anyone know what LIFO stands for? Yeah, last in, first out. And FIFO is first in, first out. Now, I have heard people pronounce this LIFO and FIFO, and if you want to, that's fine. I'm going to say LIFO and FIFO. Now, LIFO and last in, first out means that when I account for the cost of something in my cost of goods sold, I'm going to assume that it was the very last one that I purchased. Now, physically, is it? Doesn't have to be, right? But to put a value on the cost of that thing, I'm going to use the very last one. And in inflationary times, that's going to be the highest cost. Now, what's that going to do versus first in, first out, where I'm going to be putting the lowest cost on it? Well, it's going to do a couple of things. First of all, it's going to drive up my cost of goods sold. It's going to drive up my cost of goods sold if I'm doing LIFO because the costs that I'm assigning to these are the highest ones possible. Why would I want to do that? What benefit does that bring me?
Lower taxes.
Yeah, it's going to lower my pre-tax income, therefore it will lower my taxes, and taxes are a real cash flow. By the way, LIFO and FIFO, other than taxes, no reason to prefer one over the other. Now, what about inventory? If I'm saying I'm selling the most expensive ones out of my inventory, what's that going to do with the remaining value on the shelf? Is it going to be undervalued or overvalued? Yeah, it's going to be undervalued if you're thinking in terms of replacement. And so if you're using LIFO, your cost of goods sold is going to be higher, your inventory is going to be lower, therefore your inventory turns will be higher. If you look at FIFO, you're going to have a lower cost of goods sold, but that remaining inventory on the shelf is going to have a higher value because you're still including those expensive ones on your shelf. And so your inventory turns will be lower. Now, operationally, is there any difference? No. The only difference is how we're accounting for this for tax purposes. By the way, when I first went to work for Halliburton, we were using FIFO, and that's one of the first things that the new management team did was switch us over to LIFO, and it made a huge difference in our taxes. By the way, both are legal under U.S. tax law. And it's so funny, I took some Chinese MBA students to visit, a friend of mine is president of a company, and we were asking questions, and one of the questions I asked was, do you use LIFO or FIFO? And this guy, who's an accountant by training, he says, we use FIFO, and all my Chinese students gasped, right? Because they knew in inflationary times, which is almost always the case, that LIFO is going to save you money on your taxes. I'm like, bro, maybe you should think about, changing that up. It makes real differences because taxes are real cash flows. Questions?
Company that sell like grocery, like grocery stuff, like Walmart, do they mostly want to use FIFO instead of LIFO?
So they would. Okay, so the actual life of the goods doesn't really matter. What you're talking, there's an operational thing about rotating stock on the shelf, right? And in fact, what I would tell you is for a company like Walmart, it won't make a lot of difference to do LIFO versus FIFO because the oldest one on the shelf is probably one you only bought a week ago. And the newest one is one that you bought yesterday. And so the price difference won't be that great. So the benefit isn't going to be as great for someone with really high inventory turns because they're selling their inventory so frequently. Where it really matters is when you buy something and put it on the shelf for a very long time. For example, when I worked at the nuclear power plant, we had stuff on the shelf for years because if the reactor went down, we had to have something quick, right? So you want to keep it on the shelf. And so LIFO would be more important in that situation. LIFO will be more important to Ace Hardware than to Home Depot for the same reason. Does that help you understand? Thank you. Okay, now we've got 3 minutes left. You guys thought I was going to say we'll stop, but no, we won't. Let's talk just a little bit about long-term financial planning. In accounting and finance, when we say long-term, what do we mean?
Over a year.
Yeah, more than a year. Dang it. More than a year. Okay, now, what I'm going to teach you is not really long-term. What I'm teaching you is for next year, right? And then you could extrapolate this on out and it could become more and more complex. But what I'm going to teach you is just about what to do 1 year into the future. And we are going to be doing this financial planning, which is what we're talking about, in the wake of strategic planning. You might think that as a finance guy, I would think that finance should be leading the planning effort, but that is not the case at all. So let's talk about the strategic plan. So the managers of the firm have to get together and make decisions about what they're going to be doing in the future. What products are we going to be offering? What services are we going to be offering? And who do you think kicks that off? Who are my marketing people? Marketing guy. Marketing guy. Here's marketing guy knows. He knows what's going on out there. The marketing people are like the pirate in the crow's nest that are looking out for threats and opportunities on the horizon, right? So he's telling us, he's coming in, he's like, hey, there's this huge opportunity in this particular area. Oh, and by the way, this other thing that we do, it's basically going away. And so we need to pull out of that area. And so that's, the marketing people come in there. Now, he comes in and he's got this great idea. He says, you know what would be really great would be a cell phone that you could roll up to the size of a cigarette and you could stick it in a little pocket over here. Wouldn't that be great? Now, this is where engineering comes in. By the way, do you think engineers would love the idea of a phone that you could roll up?
No.
Oh, hell yeah, we would love to try, right? Does that mean we're going to succeed? No. And engineering is like, yeah, that's a great idea. Now, it's not quite technically feasible yet, but we're getting there. And in the meantime, we could do this foldable flat phone. And then we get accounting involved. And they tell us, hey, your idea for the flat phone, we're going to have to charge $2,000 for that damn thing to make any money. By the way, do any of you have one of these flappy phones? You do. Do you enjoy it? No. Okay. They're not ready yet. And so that's engineering's talking about feasibility there, and they're going to talk about we're not quite ready for that. And accounting says, by the way, these things are going to be expensive to make anyway. And then so that idea would get killed off. But if an idea is good, then it will continue on through the process. And so the managers are going to decide which of these new products that they want to introduce and which existing products should have their production reduced. And what that's going to do is impact our need for assets, and that impacts our need for financing. And so that's what we're going to do next time. In fact, I'll tell you an actual example from my real work history next time. Also bring your stuff from chapter 2 for a review.